Hi, good morning, everyone. We'll just give everyone a minute to assemble and then we'll begin. All right, let's get started. Good morning, everyone, and welcome to yet another Saturday morning session in our webinar series, Decipher with Deserve. As always, we'll try and dive deeper into another area of discussion. This session can't be more timely to discuss the role of gold and silver in your portfolio. To begin this session, let's welcome our experts for today. We've got with us Vaibhav Porwal, co-founder and CIO of Deserve. Hi, Vaibhav.
Hi, good morning, Hardik. Good morning, everyone.
Hi. Vaibhav, as most of you would already know, has been instrumental in shaping investment decisions of some of India's largest wealth creators over the last 20 plus years. With him, we've got Pratik Bagaria. Hi, Pratik.
Hi, good morning. Good morning.
Hi. Pratik heads multiple strategies at Deserve, including our flagship equity revival strategy, as well as our strategy on precious metals called Shine. Pratik has 20 plus years of experience in crafting investment solutions that have consistently delivered investment objectives for the clients. With that, let's begin today's session. Let's start with basics. Let's go back in time. Post World War II, there was a Bretton Woods system where currency supply was pegged to gold reserves. Today, we've moved to a fiat currency based system where supply is essentially linked to sovereign credibility and central bank policy. What has changed?
So, Hardik, I think let's go back further in time. Right from the Roman Empire days, gold was always considered a form of currency. Coins used to get minted in gold, and people could trade in that as a currency. It continued right till 1700 century or 1800 century, and thereafter global trade started emerging. And during Napoleon War, again went back to gold trade. But over time, as countries started to face more and more inflation and demand for money, they started printing more money. And a good breaking point in this was World War One, where countries broke away from gold pegging of currency and started printing much more than what amount of gold reserves they had. Thereafter, we had a situation where again all the countries went back and said, let's continue to trade our currency and peg it against gold. But in 1930s, when deflation started, many countries like Britain and US broke away from Great Depression during Great Depression era. They broke away from this system. And then World War II happened, and thereafter there was a new arrangement which was created for global trade, which was called Bretton Woods Agreement. Bretton Woods Agreement essentially said that dollar will be the global reserve currency, and US will maintain gold equivalent to the amount of currency that they are issuing. And every other country's currency was pegged against US dollar. You could exchange your currency against US dollar and get 35 ounce of gold. Obviously, after that, a lot of development took place, and in 1960s, US started printing far more money than the gold reserve that they had. And world started getting a whiff of this, and in 1971, post Venezuela war, Nixon finally came out and said that we are breaking away from Bretton Woods Agreement. So till 1971, currencies were actually pegged against gold. So it's essentially paper which represented gold. It's in some way similar to what today's exchange traded funds of gold and silver represent. You have document which is pegged against, and you can convert that document into gold whenever you want. In 1971, we broke away from that, and thereafter, gold USD became the global currency, global reserve currency. So that's been the journey of gold till Bretton Woods Agreement. And After collapse of Bretton Woods Agreement, there was a period where gold went up from 35 ounce per dollar to almost 850 ounce per dollar. And then the famous Paul Volcker era started, where inflation went through the roof, and as a result of that, he started increasing interest rates. And interest rates in US went up to as high as 20%, which led to a collapse in prices of gold. From $850, it came down to almost $250 and stayed there for next 20 years.
So that's $850 per ounce to $250.
$250 per ounce and stayed there in pretty much plus minus 10% range for next 20 years. After 2000 dot-com bubble, again we got into a situation where money supply started increasing disproportionately, and people again started looking at gold as an alternative to fiat currencies. And 2000 to 2008, we saw a decent up move in gold. Prices went up to 850 again from 250. Thereafter, when the global financial crisis hit, we crossed $1,000 for the first time and went up to $1,100. Post 2011, when the prices hit, or 2012, when the prices hit their high of $1,900, again, globally things started stabilizing. And gold, as all of us know, works best when there is a widespread fear against fiat currencies in the world. And from $1,900, we again came down to $1,100. But 2018-19 onwards, again the era of massive printing of currency, which started, which continued through COVID. And post-COVID, the confidence in US dollar as a reserve currency started going down. So during this period, gold went up substantially from 12, $1,300 all the way to $4,000, where we are sitting today. So that's been the fascinating journey of gold for last 2000 years. It's always been considered a mode of exchange and currency, valuable currency in users' mind. For a brief period of time in the history, US dollar claimed that space, but looks like gold is reclaiming that status again.
Great, Vaibhav. Thanks. We felt we were in a time machine going back in the era where gold was a currency of exchange to today, where gold perhaps is a store of value against depreciating currencies. Vaibhav, one of the fundamental questions, and Pratik, you can correct me if I'm wrong, the reason why gold prices were published in USD was also that when Bretton Woods was formed in 1944, US held about 70% of global gold reserves. And
Right.
that's when the entire era started. And till date, gold prices are always quoted in US dollars, and then, of course, various currencies then convert them into their individual currencies. Is that the understanding?
Yeah, yeah, that's correct. Most of the international exchanges, they quote dollars, the gold price is still in dollars.
Perfect. Moving on, and this is one of my favorite topics to discuss. Gold, obviously, Vaibhav, you've taken us through the history as a currency and store of exchange, store of value. But at the end of the day, it's still an unproductive asset. Unlike equities, where we are buying companies for the cash flows and growth that they generate, gold has neither of those attributes, right? And I'll actually quote Warren Buffett here verbatim. He's actually mocked gold in the past. So, in Warren Buffett's words, gold gets dug out of the ground in Africa or someplace. Then we melt it down, dig another hole, bury it again, and pay people to stand around guarding it. It has no utility. Anyone watching from Mars would be scratching their head. What's your view, Pratik?
Yeah, yes. Buffett has a way of saying things that stick, right? And anyone watching from Mars, that's the killer line. But yeah, here's the thing. Just because so how Buffett would watch it is that it is non-productive. It's not a goose that lays golden eggs, right? Like his Coca-Cola, it's not a wealth creator. It's a store of value. So just because something does not produce cash flows, but it does not mean it's not valuable. For example, in our house, there are a lot of productive items, right? You have refrigerator, you have mixer grinder, etc. These are productive stuff. But so they have their value. But let's say even something like a family portrait or a temple, most of it they have. While you can't call it directly productive like a mixer grinder or a refrigerator, but it still holds value. So that's what gold does. It's kind of the properties that it possesses, that it does not corrode, it does not lose weight over time, it has that shine, the properties that it and it's also rare, which is one of the biggest property that it has. That makes it a store of value. And its actually utilities lies in the stability and the 6,500 plus years of history that it has been with mankind, older than some of the gods that we've worshipped today. So yeah, um, not productive definitely, but it has
There
value.
is a value
Yeah,
given
yeah,
the attributes that you
yeah.
mentioned. Fair. You know, we've gone through the history, we've understood besides it not being productive, there is value to gold. Uh, would love to understand now that we have clarity on role of gold in the modern monetary system, what are the drivers for demand and price? Few of the drivers, Weber, you did mention when you were taking us through the time lapse journey, but five, 6 pointers in terms of what are the real drivers for both demand and price of gold.
So the first thing is loss of confidence in fiat currencies. So we were discussing that gold is measured in terms of US dollar per ounce. So there is a high degree of loss of confidence in US dollar as a reserve currency. So till 2018 or 2019, the world order was very simple. US will innovate, every other country will produce for them, US consumers will consume, US will run a large trade deficit with all the countries, and that trade deficit will get funded by all the central banks by reinvesting in US treasuries. So net there was a nice arrangement where US was the buyer and other countries were the financiers of that consumer spending. Now, other countries are saying that we will no longer finance your consumption. You finance it directly. What we will do as an alternative is to invest our reserves or surpluses that we are generating in gold. So, if you look at last 5 years, there is an incremental purchase of gold by central banks of almost 1,500 tons. So, that's a significant addition to the gold reserves by central banks.
I thought I'll just share this chart. It justifies the data that you are mentioning, Weber.
And interestingly, if you look at the right-hand side data, this is after a long period of time, we have come to a situation where gold reserves held by central banks are equal to the US dollar reserves held by central banks. So
Wow.
this clearly means that this diversification is playing out. So what are the reasons? A, as I said, loss of confidence in fiat currencies. B, inflation being higher in US compared to a lot of other countries. Third, the whole geopolitical situation where uncertainty around trade behaviors of the country is pretty high. Fourth, the continuous war which is playing out in Russia and Ukraine and Israel and other Middle Eastern countries. So all of these are creating this pressure on US dollar, and gold in some sense is benefiting at the expense of a US dollar, plus incremental buying from investors who want to create some safe haven assets in the portfolio. The other thing which I think triggered this significant buying by central banks post 2022, where Russia and Ukraine war broke out and US decided to freeze all the Russian assets which were held in US dollar. So it broke the confidence of many countries by saying that if you are not in agreement with US, there is a possibility that your reserves may get frozen. So therefore, it's important that we diversify. So bunch of these factors have come together over last 4 5 years, and which has created this positive sentiment for gold.
Gold.
So almost parabolic rise in gold prices, and silver prices have also not been far behind. So these factors and combination, and along with that, obviously momentum also creates its own momentum. So all of these factors have led to this kind of up move in gold prices.
Got it. All right. Pratik, you may want to add or summarize. I know we were discussing and you mentioned there are six major reasons that drive demand and price for gold.
Yeah, so as Vaibhav highlighted, he's covered most of it. See, paper, the narrative that he was talking about, that now currency is not backed by gold, it's backed by the credibility of the nations. Now, what has happened? The credibility of the nations has have gone down because they are in debt, especially after COVID, when a lot of money printing happened, etc. That makes it difficult for one country to trust another because now they have far more currency printed. In fact, I have a chart. I'll just pull it up. Give me a sec. Can you see it? So this is the money
Yes.
supply of for the last, say, 1978 to 2024. The left one is for India and the right one is for the US. And you see the kind of money printing that has happened in the US.
Wow.
It is completely unprecedented. And that is what brings down the confidence of your investors. And obviously, the other points as highlighted by Weber, that the geopolitical tensions, the doubt that whether America will impose sanctions on you. That leverage is something that a multipolar world now is not ready to accept.
Got it. No, thanks for summarizing the drivers for demand. I'll move on to the next point. And in fact, this is a conversation we were having earlier in the day in the morning, right? That while there are drivers for demand of for gold, and those are clear, and we see that reflecting in the price. For equities, there are cash flows you discount and you arrive at some value to determine what is a fair value, and are we paying the intrinsic fair value or are we paying beyond the fair value? What is the methodology for gold? Is you I mean, one way is to say price is a reflection of the demand and you perhaps buy basis the momentum. But is there any fundamental intrinsic value, or is there any proxy for arriving at some price of gold, given where we are in terms of money supply, or any other parameter you feel which is relevant here?
So in terms of methodology, if we go back to, let's say we were still in Bretton Woods era and we said US dollar or US money supply should be the proxy of the price of gold, then the fair price of gold works out to around $3,500. Extend and say that we should look at other global reserve currencies also, like euro. Then the fair price, based on Bretton Woods formula, should be around $4,500 per ounce. If we include all the global currencies, then the number is as high as 8.5, 9,000. But many global currencies are not fully convertible. So if we exclude and focus on US dollar and euro and some other uh, currencies where capital account convertibility is there and are considered as reserve currencies, then the fair value works out around $5,000 based on Bretton Woods era formula. So that's the only methodology that we can apply. Second is there is no cost which is high enough when you want to insure against your fear. So
Right.
that's what is playing out. You don't
You can't objectively measure that. So,
can't objectively measure. You are insuring against your fear for your life premium or for any car premium or any accident premium. We don't negotiate the prices. We look at the value, and that value is measured in terms of the degree of fear. If the degree of fear is high, then you will be willing to pay much higher premium. If the degree of fear is low, then the premium goes down. So this is exactly how it played out between 2008 to 2012. When the degree of fear was high, the prices went up all the way to 1900. The moment the degree of fear subsided, the prices came down to 1100 to 1200. So, extent of fear and Bretton Woods formula are the only two metrics that I can think of to assign a value to
so,
something like
so
gold.
essentially, and we are at what, $4,000 an ounce, right? So, and you mentioned that we can apply it to maybe just US reserves or US currency supply, or maybe add euro or add the global currencies, excluding the non-capital convertible currencies. Still, you are saying even if we were to look at that objective criteria and the fact subjectively all the necessary attributes which could push up gold price, are working in favor of demand and price. Everything sort of seems to point out towards where we are today,
But as I said, fear is something which
which you
can't
can't
be
quantify.
measured. So there's an interesting data, and Pratik should be able to pull up that chart, which talks about there is the first time after 1980s where gold has crossed its Bretton Woods formula valuation.
Okay.
Pratik, can you pull up that chart?
Yeah.
First time since 1980s.
1980s, yeah.
While Pratik pulls out the chart, I'll request the attendees here, if you've got any questions, you can post it on the Q&A box. We'll perhaps take 15-20 minutes to wind up our session and then take questions from the audience. Feel free to post it on the Q&A box. In case you're finding it difficult uh, to post it here, you can obviously reach out to any of our wealth managers to have a separate conversation on this. Meanwhile, yes.
Yeah.
Yeah, so if you look at the right-hand side chart, the gold prices in dollar per ounce are in light orange color. And if you look at Bretton Woods formula and compare it, this is the first time the gold prices have crossed the red line after 1980s. So that obviously means that now we are seeing far greater risk compared to what we saw during that era.
Amazing. Great. uh, that establishes the point around how can we value this. Now, moving on from gold, we've sort of discussed everything relevant to arrive at where we are in terms of gold. Let's discuss the more trendier metal these days, silver. Often it's called the poor man's gold. Today, if you ask me, it's driving more attention and, of course, price appreciation related to the more revered metal, which is gold. But let's get to the basics here, right? Silver, of course, has some industrial application. So, in terms of attributes, is it more industrial commodity or copper-like, or does it have any role in store of value? How should one look at silver?
Yeah. So I'll try to answer that. Actually, silver is plays a dual role. One is the store of value. At the same time, it has a good industrial use also. Earlier, it used to be used in things like photographs and films, etc. But now there are more new age applications of silver, like EV batteries, AI chips, or say even 5G devices and medical devices. These kind of technologies, they use silver as it's a great conductor of electricity. So one part is, yes, the demand for industrial demand for silver is there, and it's coming from the new age growing sector. Secondly, what is driving the prices is that it has, relative to gold, it has not rallied as much. So if you look at the gold to silver ratio, that had spiked. So generally, silver trades at around 65. Gold to silver ratio is around 65. That increased to around 100. And some bit of the rally that we are seeing now is a catch up that silver is playing with gold. So actually, in this chart, let me show you here. So this is the gold to silver ratio for the last 40-45 years.
This is
And
in terms of price. So, essentially, how many
yes,
ounces of silver it takes to buy 1 ounce of gold?
yeah. So it went up to 1 ounce of gold would be 100 ounces of silver. So that was the level that we had reached. It started just catching up. Generally, this goes up till 65 or thereabouts. That is another reason on a technical basis that it's going up.
Got it. So, coming back to the industrial applications, so from a store of value, you said we should look at the fact that there is a gold to silver ratio in terms of price that we've seen at some average levels across the years, and then it tends to come to the average. Is that how one should look at it?
Yeah, in fact, it comes down to average and below that. So the next time it's fairly possible that it goes below 65 uh, and and oscillates around the average.
Fair. So two takeaways. One, of course, there are industrial applications, and they've only increased in the era where we've got, EVs and battery requirements, the solar panel requirements,
Yeah.
but also the fact that there is a price correlation to gold, uh,
Mm.
given that there is some role in terms of store of value as well.
Yeah.
Great. Moving.
Other factor, I just to add one more point. If you look at demand supply dynamics also, silver demand is higher than the supply. So that's also a big factor in
Yeah. And in fact, that has been for the last around 4 years that we have a net negative supply of silver. So it's the recycled silver, etc., that we are using for the last 4 years. It's not the new product produced silver. Yeah, thanks.
Got it. Fair. And we'll come to what has occurred in silver over the past few days subsequently once we've covered the core agenda for today. So I'll move on to equities, in comparison with gold. This is classic question that we get from most of our clients, that in last 1 year where equities have been relatively quiet and gold obviously has seen record appreciation, should I wait to buy equities and rather buy gold given the momentum? How would you think of equities versus gold?
so it's never one versus the other. So when you are deciding on your asset allocation, you have to make sure that 5 to 10% of your money is invested in an asset class which ensures your portfolio against any kind of global shock. We are operating in a fully globally integrated setup now, and in that setup, we need some shock absorbers. So gold and silver, in my mind, are playing that role, and equity plays the role of economic growth. So in some sense, gold is preserving your wealth and equity is growing your wealth. In fact, we did an interesting analysis at what percentage of gold, Pratik, you had done that analysis if I'm not wrong,
Yeah.
what percentage of gold we are able to absorb the shock in the portfolio over a long period of time. Obviously, in a short period of time, price movements can be erratic, but over a long period of time, there is a number which a magical number which ensures that your portfolio is insured against any kind of global shock. Pratik, you want to talk
7%.
about that number? Yeah.
Yeah, so 7% is basically if you buy purely equities, what will happen is the your return in dollar terms that might not be stable because, as we all know, rupee depreciates against dollar. But if you blend that equity with around 7% of gold, your the rupee return, it does not erode in value. It because your gold takes care of that depreciation in the currency.
Got it. So it's not equities versus gold, it's equities and gold,
Yeah.
given they fundamentally solve for different problems in your portfolio. Moving on to Bitcoin, another trendy topic. Uh,
In fact, on equities and gold, I would like to share a long-term chart also. So let's say somebody starting with 1,000 rupees, 4,500 rupees in Sensex has almost crossed 65,000,
okay.
whereas somebody with gold is close to 20,000. So, or in another terms, equities have done 15% per annum and gold has done 12% per annum. So there is a good 3% difference between equities and gold. And this is also after not accounting for any dividends or the storage cost of gold.
We can all
So,
see the difference that 3% can make over
Yeah.
a long duration. Sorry, Vaibhav.
no, so dividend in equity and storage cost in gold. So gold return should ideally go down and equity return should go up a
Yeah.
bit on
Yeah.
account of these two variables.
Got it. No, and moving on to Bitcoin, Pratik, Vaibhav, are we really looking at birth of a digital gold? Given the modern monetary system and perhaps the future monetary system could look very different compared to where we are today. How do you look at Bitcoin? Of course, India has its constraints in terms of cryptocurrency purchase, sale, in taxation as well as in storage. But what's your view on Bitcoin fundamentally?
See, it exhibits all the attributes of gold besides one. So it is rare or scarce compared to fiat currencies. You can't continue to print or generate bitcoins the way you can print currencies. You obviously price is independent of how central banks see it, and it's free from any regulatory intervention. So all of these are attributes which are extremely similar to what gold would do. One attribute which is different is regulators have still not included this as part of their reserves. And there are a lot of countries where, like India, where restrictions are there, multiple restrictions are there. So if regulators also align with this philosophy, then it will complete the full requirement of becoming a reserve currency. So that's one variable which is missing, and which is possibly stopping it from becoming a digital gold kind of an equivalent. So we'll have to wait and see how regulators react to this phenomena, and basis that we can decide. As of now, central banks are buying gold. Central banks, very few central banks are investing in cryptocurrencies.
I
Gold
think
has a 6.5 thousand years of head start, you can say. So Bitcoin has some catching up to do. Also, it has a lot of simplicity in terms of so any Bitcoin transaction would depend on electricity and stuff like that, right? Whereas uh, at least a one-to-one transaction does not stop gold from being transferred without any those things. So there are a lot of debates, but since we are not allowed to, as it is, invest in Bitcoin. Yeah.
fair. Great. In interest of time, I'll quickly cover the next couple of questions. Best way to buy gold. There are, multiple ways you can buy it. In physical, there are ETFs, there are digital gold backed by custodians, and then of course there are SGBs. What would be the best way to buy gold?
SGBs undoubtedly, because you have 2.5% interest over and above the return of gold, and that too tax free. But unfortunately, your SGB is no more getting issued by RBI.
There's no fresh
Uh,
supply. Yeah.
so your gold ETFs become your next best choice. Better than physical gold because the storage cost and risks are not there. Plus, the physical gold requirement is already fulfilled by for most of the houses in the form of jewelry.
Jewelry. And even the transaction costs. I mean, for digital gold, etc., the transaction costs, uh,
Yeah,
which are
correct.
incidental to purchase, are significantly high compared to ETFs. So we'll stick to ETFs for now. Uh, Again, in terms of allocation between the two precious metals that we've discussed, gold and silver, how should we look at it? What is permanent? What is tactical? How do you look at changing, making a shift from one to the other?
So, uh, gold is actually much more stable compared to silver. I would just like to again show this volatility chart here. Yeah, so this is the price of gold for the last 40, 45 years, around starting 78, and this is the price of silver.
Hmm.
Look at gold even after, as Webovich told us that it went down after Paul Volcker started reducing rate. It went down from 800 and it stayed there, but the drop was around 40 40 30 30 40 50%, right? And it stayed there for a long period of time. But the same thing in silver, look at how accentuated that is. It fell from $50 right up till $5 or $6, and it stayed there for the next whatever 30 years or so, only to come back in 2009 9 10. So this silver is much more volatile. We have seen, and it's not the first time. You also saw again a drawdown in silver after 2011-12. So yeah, it's a volatile asset. It's best used as a tactical uh, allocation because it can give you a sharp up move, but your base allocation should be in gold.
Got it. No, that makes sense. One last question before we open the floor for questions from our audience. Uh, we've seen for another precious metal, diamonds, how LGDs came and literally the price and demand for natural diamonds has significantly deteriorated over the last few years. Do we foresee any existentially disruptive event for gold?
Good for us, right? Easier to gift on anniversaries and birthdays. So, any view, Vaibhav?
I think okay, so it eventually boils down to cost of production versus cost of mining. So there are some experiments which were done trying to produce gold in a lab, but the cost of production in a laboratory setup is much higher compared to cost of mining. So it's a basic mathematics which is at play here. You can create that, you can create the same composition in the laboratory setup, but to produce large scale gold, the cost of production will always be much higher compared to the mining cost. So that's the basic answer to this. In case of diamonds, the cost of growing diamonds in the lab is significantly lower compared to mining. So that creates the difference.
We were discussing yesterday, Pratik, you mentioned
Yeah,
diamond is nothing but carbon, right?
carbon.
Essentially, at the
Yeah,
end of the day, which is available at scale and at significantly no cost, I would say, actually, not
yeah.
lower, but versus
So,
gold itself is an element, though it can be manufactured, the cost is astronomical today.
yeah. So in diamond, what you are doing is you are shaping or you are playing with the element carbon which is available. But in case of gold, you are creating the entire element itself. So it's much more expensive, and for the foreseeable future, at least, you don't see any such threat right away.
Got it. Great. I will pause our discussion right now and open this webinar for questions from the participants. We've already got several questions. Thank you for the insightful discussion so far, Vaibhav and Pratik. Let me get to the first set of questions. All right. Uh, any key risk to price and demand that you see from here? Let's consider price. What are the key risks to price, gold price from here on?
So I think again going back to the same two factors that I mentioned earlier, which led to this up move. If global stability returns and confidence in US dollar reinstates, then obviously gold prices can correct. Second, the degree of fear which is there in everyone's mind, if it reduces, then the gold prices can correct. And both of these factors in some manner are slightly unpredictable at this stage. And therefore, I would not say that you should look at this more from returns perspective, but look at it more from the insurance perspective and have some part of the portfolio invested in gold or gold or silver or
Awesome.
gold and silver.
Got it. Any correlation that can be drawn from cost of mining gold versus market value? Is there any such
Uh,
trend?
well, cost of mining is not that high in case of gold.
Got it.
It is scarce, but it's not rare.
Uh, got it. Just let me move on to the next question. Given the recent appreciation in gold and silver, what would you suggest for somebody trying to create a portfolio around gold and silver right now?
I think you should not create a portfolio only around gold and silver. That's the first point. If you're creating portfolio of multiple asset classes, then gold and silver should be part of that and disregard the short-term movement in the price. From a long-term perspective, by 8 to 10%, you can take next 3, 4 months to deploy that money in your gold and silver allocation. The ratio that we are following right now is 75% gold and 25% silver. We were in our strategy in 50% gold and 50% silver, but we reduced our silver exposure to 25% and increased our gold exposure to 75%.
Uh, this is an interesting question, actually, and this is something Prateek you would be able to respond. Why gold allocation should be max 5 to 10%? Why can't it be 50%? And you were talking about Turkish portfolio yesterday. Perhaps you could shed some light here.
Yeah, so there is a concept called Turkish portfolio where the investors in Turkey, they combined a portfolio of 50% equity, 50% gold. And that worked very well for them. But that was Turkey. The reason it worked there because was the inflation they were seeing was very high. They went through a long phase of hyperinflation, which is not at all the case in India, right? We are dealing with 2%, 3% inflation right now. And there does not seem to be any case where inflation will go bonkers and run at 20, 30% or so. So that's the reason you don't want to go with a 50% allocation. One. Second is that, again, going back to what we started with, ultimately gold is a non-productive asset. So while it will sit there as a store of value for you, it will not generate new wealth, or it won't create wealth. So given a choice between a goose that lays golden egg versus a golden egg, which one would you choose? That you would do 50-50. The equities are like the goose.
So we stick to the 7-10% of the portfolio approach.
Yeah, that's enough to hedge the portfolio. The thing is, investors most of the time they don't either have 7 or 10% also.
Got
And
it.
then the rally happens, they try to catch up and uh, yeah.
And a related question to that, given that the rally has happened, would it be best to do a lump sum investment or take an SIP approach, given we can invest in ETFs anyway?
So we are guiding investment over 3 months. So next 3 months we'll have enough clarity. But as I said, the objective is not to optimize price entry. Objective is to create allocations in the portfolio up to 10% and then sit with that for all a very, very long period of time.
Got it. Uh, Linking it to macro global events, recent tariff news and the tariff wars, incidentally, yesterday, the post that Trump had against China, could that impact gold, silver prices in short, long term?
I wish we could sit in Trump's head and decipher what he's thinking.
Decipher with Trump. Yeah.
Even then we would fail, I think.
So, honestly, very, very difficult to predict. 1 week is anti-India, next week is friendly with Modi, and again, in the subsequent week, he's negative on India. 1 week he's positive on China, next week he's negative on China. So, very difficult to predict his behavior. But eventually, if you look at the sound principles of economics, global trade has to move smoothly, and large part of the global growth over last 40, 50 years has come because of integration of all the global economies. Moving away from that is not going to help anyone. So that realization should happen soon enough in US also. The thing which has happened so far is inflation has not started hitting the consumers because initial part of the hit was absorbed either by the producers or by the either by the importers or by the exporters. Once the consumers start facing price increases and inflation pressure, then obviously there'll be significant change in stance.
Makes sense. Uh, Pratik, this is actually a very interesting question, given, you showed the chart comparing past volatility of silver to gold. Uh, is it questionable now in future, given semiconductors and new EV era coming in, the demand for silver is supposedly going to rise significantly? Should we use past volatility as a judge for future performance of silver? How would you look at silver in this era?
So the nature of returns changes quickly, right? Every year you would see very different returns, but the nature of volatility changes very slow. So if you think that there has been a structural change in the nature of volatility of silver, that will not be the case. Because suddenly, so we've been seeing a build-up of demand for silver, right? The next phase that we could see could be a build-up of supply for silver, and that's how it always works in commodity. You have first demand and supply, then them playing cat and mouse. So I don't think it will do structurally anything very different. It continues to be on one side an industrial metal where it is found its ground in terms of new technologies adopting it, and on the second side it's store of value where it is running along with gold.
Got it. Some of the questions have been addressed. Uh, there are questions around some platforms for buying digital gold, and then some extra returns given on top of it. I think they also lend and borrow gold. Any comment on that, Vaibhav, Prateek?
Yeah, honestly, as long as it is outside the regulatory purview, I'll be extremely careful with that. Plus, digital gold platforms charge high upfront fee. What we were checking was the upfront fees as high as 4 to 5% of the value of gold that you are buying. So, which takes away large part of your allocation. I would keep it simple and invest in ETFs, which are available at low cost, are much more tightly regulated, and are much more liquid and cost and tax efficient. So.
Got it. Vaibhav, now that we've mentioned ETFs as a preferred choice to invest, let's talk through what occurred over the past few days in terms of ETF prices being significantly higher than spot prices, significantly higher than future prices. What really happened in silver over the past few days?
So actually, this phenomena played out in silver only, and that's where we need to exercise extreme caution when we are buying ETFs. We need to look at the underlying value of silver or gold or any index that we are buying and see the prices at which ETFs are trading. During times of volatility, this can play out. So in silver specifically, over last 3 4 days, there was no supply of physical silver. So whenever you wanted to buy an ETF, these ETFs in turn need to go and buy physical silver. And physical silver was not available in the market because of lack of supply. We spoke about demand supply mechanics in silver, and supply was not available. As a result of that, people started trading ETFs. Existing unit holders started selling their ETFs at premium, and which created this entire pressure. This dislocation keeps playing out during volatile periods of time. During COVID, I remember bank ETF, banking nifty ETF, started trading at 5% premium intraday because
Wow.
there was so much volatility that
Yeah.
market could have gone either way. So that is something that you need to be mindful. We sold our ETF exposure in silver to realign our portfolio, and one part of the reason was this premium which was trading in the market, because you can extract that premium for our investors.
Fair. And usually this volatility dies down and prices converge, right? What would typically be the time period?
To 15 days time. Since
Got it.
arbitrages are there in the market, so what you would do, you would buy in the futures market and sell your ETFs, and eventually, as
Make
you
the
keep
spread.
doing it, prices converge. It's a
Right.
typical arbitrage trades, and arbitrageurs will uh, kill the spread over 10 to 15 days time. Markets will eventually come back to the efficiency level at which it should operate.
Vaibhav, do you also think it could be a factor of the festive season? Because it's a time to buy silvers for most of the Hindu households.
And also that this price differential existed in India, as far as I know, not globally.
No, not globally. So the issue was, and I spoke to a few bullion traders, and they were saying that there is no physical lending of silver which is happening in the country. So they can't fulfill their commitments. The third thing is a lot of silver traders went short into unauthorized speculative markets, which are not authorized, and because they went short, they were supposed to give delivery. They were forced to buy silver in physical at much higher cost compared to what it was trading at in the futures market. So it was a multiple combination of multiple factors which resulted in this premium in cash markets over
Short squeeze plus festive demand plus all the other
festive demand
factors.
and no supply of physical gold
No
because
supply.
everything got absorbed by the speculators to cover their position.
Got it. Fair. I think this is fairly clear. Couple of questions around people having physical gold at home, which they would have historically bought. Would it make sense to sell it and buy in ETFs? What would you recommend?
So it largely depends on the tax implication. Honestly, I would not do a blanket switch. Today, if I were to do, and our investors know that for every investment decision, we do a cost benefit analysis. So we'll have to run the cost benefit analysis to arrive at what is the right step to take in this case.
So the switch cost versus the benefit that you derive is what we will assess and then accordingly we'll decide. Got it. Moving on. Sorry, some of the questions have already been addressed. We've addressed questions around allocation, overall split between gold, silver. As we've covered it in the past, gold is more of a permanent position, silver is more tactical. Uh, do these shock absorbers, are these shock absorbers present in Deserve PMS? Weber, you want to quickly take it up?
Sorry, can you repeat the question? Sorry.
Are these shock absorbers, so as to say, or hedge available in Deserve PMS as well?
Yes, yes. We run a strategy called Shine, which invest into precious metals, where we use a combination of gold and silver. And depending on our view on each of these commodities, we keep changing our allocation to them. The objective here is to deliver returns which are much higher than what each of these currencies will deliver individually.
Got it. Uh, Physical gold versus ETFs, we've already addressed that. On other commodities, like copper, oil, do we have any views? Would they form part of any strategy? Should investors allocate any capital over there?
Ideally, you would have allocation to some commodities, but there is no mechanism to invest. Plus, a lot of other commodities, as gold and silver are trading at lifetime highs, a lot of other commodities are trading at lifetime lows also. So it's not a simple, straightforward answer. Depending on where we see the value, we allocate money. In India, in a tax efficient manner, through a regulated structure, you can only invest in gold and silver ETFs. Other ETFs are not available. So that's the limitation
But
of.
Pratik, you were mentioning that there is, anyway, some proxy allocation available, given that you would have invested in some companies which are into commodities, Hindalco, Vedanta, etc.
Yeah.
So thereby some allocation to that rally would anyway happen by default in your portfolio. Is that right?
Yeah, so sometimes these uh, metal producing companies, base metal producing companies, their prices are tightly correlated with the prices of the underlying commodity. Uh, Exposure towards something like, say, a Hindustan Zinc, which produces zinc and silver as a byproduct, does give you some sort of exposure towards these commodities. A lot of players also do it through mining companies, gold mining companies, silver mining companies.
Got it. Got it. Uh, Generally, should people look at some benchmark return expectation in these strategies? I mean, there are a few questions around. We were always given to understand that gold, silver gives 7 to 8%, but last couple of years it's doubled. What's your take on what return percent? Equity, we always have some number to benchmark to, right? How should one look at returns in these, or should they even look at returns?
So don't look at returns because in these asset classes, returns are extremely lumpy. There will be prolonged period of time where there will be no returns, and suddenly you'll see a period where returns are extremely high. So which is what we saw over last 18 months in case of gold and silver. So I would not
And it
ask
sort of offsets the dull period in equities to
that period
some
in equity
extent, right?
market, but always coincides with that. My view is that as a principle, we believe that gold is a great inflation hedge. And whatever the consumer inflation is there in the country, you will continue to generate returns higher than that. Plus global risk premium. So global risk premium can at times be higher or at times it can be lower.
Got it. Will recording of this webinar be available? Yes, this will be available. Buying physical gold versus SGB, we've already covered that. How about copper? We've covered that. Uh,
Copper is somewhat similar to silver, a lot of industrial use, and industrial use is increasing also in new industries. But obviously, there is no way to take exposure through ETFs in copper.
uh, which are the best sources to get trustworthy prices of spot prices of gold and silver?
There are enough platforms which are available. We can share a link to a
So
few
the
platforms.
question is more around differential pricing of ETF and where should they find the appropriate price?
MCX is a good
MCX
source.
is a good source.
Yeah.
A good source.
Silver ETF trading at a premium that we've already discussed. Okay, this is another question where people would have historically taken about 10% exposure to gold, silver. But given how equities have been flattish over last 1 year, but gold has significantly moved, the exposure has significantly increased to 20-25% of portfolio. What should they do in such scenarios? Firstly, be happy, but
Firstly, I think congratulations and long term, I would like to bring it down to 10%, but for next 6 months, I think we can continue with this higher allocation.
should we consider household jewelry as part of gold allocation?
If the
You should
spouse
ask your wife actually.
my spouse doesn't allow me to consider that, so
But is a relevant question given some of the households may have significant jewelry accrued over periods of time. Should that be considered, or that should be purely seen as consumption and your gold allocation should be more ETF based?
it's similar to asking me whether you would consider the residential house in which you're living as your real estate investment or a real estate for consumption. I think for most of us, jewelry should be considered as consumption only, for consumption only.
Okay. Uh,
You can add that to your operating expense, your jewelry.
One last question before we wind up for the day. How about multi-asset funds which have exposure to metals?
So yeah, we do have a strategy around that also, where we invest in some multi-asset funds which take exposure to not just gold and silver, but to REIT and InvITs also, some fixed income and some equity. So that is also something that can be discussed with your relationship manager. In fact, we should end the webinar with a very interesting slide that we were discussing.
Pratik, yeah, I think you
Yeah,
should present that slide.
I have it.
No, while Pratik pulls that up, thank you so much, Vaibhav, Pratik. I think we go much more wiser in our understanding of gold, silver, their role in the portfolio, what drives demands, where are we in terms of allocation. uh, Truly, they're not here to outshine equities, but to balance them. And I'll, before Pratik presents, close it verbatim with Pratik's thoughts. Equities grow your wealth, gold preserves it, silver adds tactical spice. Build your allocation through process and discipline, and let your portfolio be a reflection of your conviction, not market's emotions. And, this is a good meme to end the webinar. Thank you so much for providing us with the clarity and nuance to understand this asset class. To our attendees, thank you so much for your participation and all your questions. And more so spending this Saturday morning with us. We are at the end of the hour mark. Enjoy your weekend, and we'll come back soon with our next session. Thank you so much, guys.
Thanks everyone. Thank you.